Following the closure of the Strait of Hormuz, the market reacted instantly. Brent crude, the global price benchmark for oil sourced from the North Sea, surged 55%, climbing past $110 per barrel in less than a month. Financial headlines and institutional investors are currently fixated on this spot price. They are treating this immediate energy spike as the peak of the crisis, assuming the worst is already behind us. This map shows the physical reality of the blockade. The Strait of Hormuz is the world's most critical maritime choke point, a 21-mile-wide passage that serves as the singular route for Persian Gulf energy exports. Its closure has trapped 20 million barrels of oil per day, up to 30% of total global seaborne consumption. U.S. shale cannot quickly replace this deficit. Domestic operators are bound by strict capital discipline, prioritizing shareholder dividends over new drilling. Even with record prices, the physical lead time to bring a new well into commercial production is 60 to 90 days. The spot price of crude is the visible tip of the iceberg. Beneath the surface, a delayed structural inflation wave is currently traveling through global supply chains, largely unnoticed by the broader market. Raw material shocks move through the economy with a specific transmission lag. It takes 4 to 8 weeks for energy scarcity to hit producer price indices, the wholesale cost of manufacturing. It takes several subsequent months for those costs to reach the consumer price index, or the final price at the register. This secondary inflation wave is transmitting through 3 interconnected channels: fuel, fertilizer, and finance. Consider petrochemical feedstocks. Modern manufacturing and packaging rely on chemical compounds refined from naphtha and natural gas liquids. Within weeks of the conflict, the price of polypropylene, a ubiquitous plastic polymer, jumped 24%. Consumers aren't seeing these price hikes yet because downstream manufacturers typically hold 30 to 60 days of pre-existing, cheaper inventory. They are still selling goods produced with materials bought before the war. This timeline tracks the path of the shock. Once these cheaper corporate inventories are exhausted at the end of the second quarter of 2026, a synchronized wave of price increases will hit the global consumer goods sector simultaneously. This energy shock is not linear. Downstream, it destroys operating margins in specific, disproportionate ways. The aviation sector provides a clear example. While unrefined crude oil rose 55%, the price of jet fuel effectively doubled, soaring to nearly $200 per barrel. This chart shows the crack spread, the price gap between raw crude and refined jet fuel. Following refining disruptions, this margin surged from $21 to $144 per barrel. Standard airline hedges covered crude oil, leaving them fully exposed to this explosive refining markup. This hedging failure forces immediate, variable fuel surcharges on passengers and air freight, injecting core service sector inflation into the economy months before the rest of the shock arrives. The crisis extends into heavy manufacturing, where the automotive sector relies on inputs from the Gulf. The Gulf Cooperation Council nations produce roughly 9. Qatar produces 1/3 of the global supply of helium, which is a critical, non-substitutable element used to cool the machinery inside semiconductor plants. Following the blockade, helium spot prices jumped 40%. This introduces immediate scarcity for electronic control units, the microchips that manage everything from engines to battery systems in modern vehicles. Confronting expensive aluminum and scarce microchips, automakers are slashing production and delaying investments in electric vehicle transitions. These material shocks ensure that vehicle costs will remain elevated through 2027. The final and most critical vector is the global agricultural system. This creates a rigid seasonality lag, locking in high costs during the critical spring planting seasons in Asia and North America. Farmers in developing nations, unable to afford these exorbitant inputs, are now forced to apply significantly less fertilizer to their fields. This reduces yield per acre, creating a secondary supply shortage of food commodities later this year. The high costs of the spring soil ensure severe global food inflation when those crops are harvested in the autumn. The agricultural cycle pushes the peak of this crisis well into late 2027. Global central banks are facing a classic stagflationary trap. They must contain energy-driven inflation while navigating a sharp slowdown in economic growth. The European Central Bank has already downgraded its growth projections. In severe scenarios, real GDP growth in the euro area could plummet to 0.4%, even as inflation reaches 4.4%. The U.S. Federal Reserve has similarly retreated from its planned rate cuts. Futures markets, which previously priced in over 60 basis points of easing for 2026, now expect a mere 32 basis points, and not until October. If global oil prices sustain a level between $120 and $140 per barrel, the global economy will cross the threshold into forced demand destruction. At this level, consumer behavior breaks. Real incomes are devastated by high prices, forcing households to cancel travel and defer durable goods purchases. Producers cannot pass on costs, idling factories and laying off workers. Central banks cannot print oil or fertilizer. They are powerless to fix the supply side of this crisis. They can only maintain restrictive interest rates until demand collapses, turning an inflation shock into a global recession. Some technology analysts argue that artificial intelligence will drive productivity gains that offset this inflation. This is a dangerous mirage for 2026. While AI has long-term potential, the expansion of the data centers required to run these models is currently placing massive strain on global electricity grids. In the immediate term, AI is an inflationary force. Its infrastructure requirements compete directly with heavy industry and residential heating for scarce natural gas resources. Corporations are responding by abandoning just-in-time supply chains. They are moving toward friendshoring, relocating production to countries that share geopolitical and security alliances. This map shows the cost of supply security. Friendshoring explicitly abandons the lowest-cost producer. Duplicating manufacturing and logistics across secure regional blocks requires sustained capital expenditure, which acts as a permanent inflation tax on the consumer. The 2026 Middle East conflict has catalyzed a higher baseline cost for the global economy, trapping corporate finance in a multi-year structural stagflation cycle.